Stocks are dropping, AI darlings are getting smoked, your portfolio looks like it just walked out of a horror movie, and every official on TV is still smiling and saying, the economy remains strong. If that feels a little 2007 reboot, now with more GPUs, you're not crazy. Today on the comment section with Thomas Paul, we're breaking down why your screen is red while the narrative is still green, how crowded AI trades and hidden leverage actually work, and what signals to watch so you stop getting played by the story while your net worth quietly bleeds. This is not sell everything and move to a bunker doom. This is stop letting vibes manage your money education. Let's go. So, you open your brokerage app, S&P red, NASDAQ red, your favorite AI chip stock down 8% in a day for no reason, and then some Fed official pops up saying, we see a soft landing and stable financial conditions. And here's where things get interesting. Both of those can technically be true at the same time. Markets can be freaking out about specific risks, while the official narrative is, nothing to see here, citizens. That's exactly why it feels like 2007-ish, not because subprime is back, but because the real risks are hiding in plain sight while everyone pretends it's all under control. To understand why this sell-off feels so violent, we have to start with the hero of the story, AI. Specifically, the you literally can't lose money buying AI hardware and data center plays trade. For the last couple of years, markets basically decided that AI is the new electricity, the new internet, the new sliced bread, and the new retirement plan. Everybody piled into the same tiny list of names. The big GPU manufacturer you're thinking of, the hyperscale cloud giants, the data center REITs, the power grid and networking plays, same cast, same positions, absolutely massive expectations, because nothing says stable portfolio like everyone on Earth crowding into 5 stocks and pretending that's diversification. Here's the plumbing behind the hype. The mega cloud companies, the Amazons, Microsofts, Googles of the world, committed to enormous capital expenditure for AI. We're talking tens of billions to build and upgrade data centers, wire them with the latest chips, and grab AI market share before their competitors do. On the other side, the vendors, chip makers, equipment manufacturers, data center builders saw this tidal wave coming and did what any rational corporation would do. They pulled demand forward. They ramped up production, signed long-term contracts, and told Wall Street, buckle up, it's a multi-year supercycle. So their stock prices didn't just assume growth. They assumed perfection. Perpetual, flawless, no hiccups, straight line-up growth. And that's the problem. When everybody expects perfection, great suddenly becomes disappointing. A company can grow revenue 30%, beat earnings, raise guidance, and still get punished because analysts had penciled in 35% with unicorns and fairy dust. Now mix in the cost side. These AI data centers are insanely expensive. The chips, the specialized cooling, the power upgrades, this is not building a Starbucks on the corner. This is more like building a small power-hungry city in a box. Those mega-cap CFOs are basically signing a multi-year mortgage on AI, except their interest rate is whatever the bond market feels like that week. As long as borrowing is cheap and investors are happy to fund it, everybody's good. But if credit gets tighter, or rates stay higher for longer, or growth even just slows from ridiculous to pretty good, the math starts to look less magical. And that's when you wake up to your favorite can't-miss AI name down 20% from the highs and people tweeting, is AI over? No, AI isn't over. The technology is likely still in the early stages. What's over, or at least getting repriced, is the fantasy that every stock-touching AI is worth infinite money, no questions asked. We saw a similar pattern with housing in the mid-2000s. The story was, house prices never go down nationally, ever. For a while, it looked true. Then the assumptions cracked, not overnight, but in a series of wait-a-second moments. Which brings us to the 2007 vibes. This is not subprime 2.0, but it does rhyme. Back then, the risk wasn't a single obvious villain stamped danger. It was a chain of assumptions. Rates stay low, refinancing is easy, credit always flows. Sound familiar? Right now, we have our own version. Years of companies gorging on cheap debt when rates were near zero. Zombies that only survived because borrowing was basically free. Private credit funds quietly stepping in to lend at higher yields when banks pulled back. A huge chunk of corporate America rolling over debt at some point between 2025 and 2027. Here's the simple math. You're a company that borrowed a ton when money cost 3%. You used it to buy back stock, acquire competitors, maybe build some shiny projects. Now that debt matures, you go back to the market and, surprise, it's 7 or 8%. At 3%, $1 billion of debt costs you $30 million a year in interest. At 8%, that same billion costs you $80 million. That extra $50 million has to come from somewhere. Layoffs, slashed R&D, fewer buybacks, less capex, or, if things are bad, a restructuring or default. Now imagine not just one company, but a whole ecosystem facing that reality in the same 2 to 3 year window. That's the debt wall people talk about. It's not a single crash day. It's a slow grind where more and more balance sheets bend until some of them break. And all of this is happening while central banks are cheerfully repeating higher for longer. Because inflation, especially in services and housing, isn't behaving like it's supposed to in the macro textbooks. But wait, it gets even wilder. While companies are bracing for more expensive borrowing, the official narrative is celebrating a soft landing. Growth hasn't fallen off a cliff, unemployment is low, inflation has come down from the peak. From 30,000 feet, the chart looks fine. At ground level, for a lot of people, it does not feel fine at all. Real wages for many workers, adjusted for inflation, are flat or barely up over the last few years. Rents are still brutal. Home prices are out of reach unless you're willing to sell organs on the dark web. Consumer credit balances are at record highs, and buy now, pay later is basically a socially acceptable way to say, I can't afford this, but future me will deal with it. On top of that, layoffs keep happening in waves. Tech companies quietly shaving headcount while announcing efficiency initiatives. Old school industries trimming staff because demand is softer. But as long as the official jobs numbers net out okay, everyone in suits goes on TV to say, labor market remains robust. That's how you can have markets cheering the soft landing while your group chat is full of, how is everything so expensive? And my landlord just raised rent again. The key point, this disconnect is not free. It eventually shows up in earnings and risk appetite. If households are stretched, they cut back on discretionary spending. Companies with thin margins start missing numbers. Delinquencies creep up, first on credit cards and auto loans, then maybe on riskier corporate debt. Investors stop paying any price for growth stories and start asking annoying questions like, but are you profitable? The market starts shifting from FOMO, fear of missing out, to quiet damage control. Not a panic crash every day, but a steady repricing of risk where the weakest business models feel it first. So, how do you, as a normal human with a Robinhood account and no Bloomberg terminal, avoid getting lost in this noise? You stop trading based on vibes and thumbnails and start watching a few key signals. Let's build a simple checklist, not to predict the exact top or bottom, but to sanity check the narrative. First, credit spreads. Don't glaze over yet, this is important. A credit spread is just the extra yield risky borrowers have to pay over super safe government bonds. When spreads are low, the market is basically saying, we're chill, defaults will be fine. When spreads start widening, it means lenders are getting nervous and demanding more compensation for risk. You don't need to know every basis point. Just pay attention to the direction. If stocks are partying but credit spreads are quietly grinding wider, that's the bond market side-eyeing the hopium. Second, delinquency trends. Look at things like credit card and auto loan delinquencies. Are more people falling behind on payments? Are those numbers rising faster than you'd expect in a strong consumer narrative? When the bottom 50 to 60% of households start struggling to service their debt, that eventually bleeds into bank profits, retail sales, auto companies, and yes, broader risk sentiment. Third, earnings revisions. Everyone obsesses over the stock's price chart, but the expectations underneath matter more. Are analysts revising earnings estimates up or down? Are companies guiding lower even while they put a positive PR spin on it? Fourth, capex guidance, especially from the big tech names. Remember that AI data center supercycle? If those mega-cap CFOs start saying, we're moderating our capex, or we're pacing investments with customer demand, that's your tell that the AI hardware party is moving from tequila shots to water and Advil. Prices of chips, servers, data center REITs, they all feel it when that happens because so much of their valuation is based on those spending plans staying huge for years. And finally, look at how many companies are quietly lowering guidance while maintaining a confident in the long-term tone. When the words and the numbers fight, believe the numbers. if your favorite bullish or bearish YouTuber is screaming crash tomorrow or melt up to the moon. But these indicators are boring and stable. They're probably selling a story more than they're reading the room. Now, what do you actually do with all this? Because you can't trade vibes, but you also can't trade a 40-page macro thesis every week. First, understand crowding. If your portfolio is basically the same 5 AI names plus their suppliers, congratulations. You are not diversified, you are leveraged to one story. That story might still work long-term, but you need to know you're on the roller coaster, not the kiddie ride. Think about position sizing. It's one thing to own the big AI winners as part of a broad portfolio. It's another thing to YOLO your entire net worth into whatever CNBC calls the next NVIDIA. If everyone you know owns the same trade and all the narratives assume perfection, just maybe dial it back a bit. Second, stress test for higher for longer rates. Ask yourself, if rates stay elevated for years, not cutting back to zero, who gets squeezed? Companies with tons of debt coming due in the next few years. No real free cash flow. Business models that only work if they can constantly refinance cheaply. Those are your zombie candidates. You don't have to memorize balance sheets, but you can look at debt levels, interest expense, and cash flow trends. If a company can't pay its bills from actual operations, higher rates are not its friend. Same for your personal finances, by the way. If your entire plan assumes cheap credit forever, you're playing the same game as the zombies, just with less PR. Third, remember why you're investing. If your horizon is 10, 20 years, your priority is surviving cycles, not nailing every twist. That means diversification across sectors, not just tech and more tech. Favoring businesses with real cash flow over pure stories and buzzwords. Keeping some liquidity so you're not forced to sell at the worst time. You don't have to choose between full doom and full hopium. You can be skeptical and still participate. And just to be painfully clear, none of this is financial advice. I'm not your advisor. I'm a sarcastic avatar on the internet giving you frameworks so you can ask better questions before you throw actual money at anything. The big picture? This moment is not a carbon copy of 2007. There's no identical subprime CDO bomb waiting to blow in the exact same way. But there are rhymes. Crowded trades everyone swears are safe. Leverage tucked away where most people don't look. A feel-good headline narrative that doesn't line up with a lot of people's actual lives. Back then it was housing never goes down. Now it's AI will fix everything and the Fed will choreograph a perfect landing. Maybe. Or maybe we hit some turbulence and a few over-leveraged passengers find out gravity still works. Your job is not to predict the exact turbulence. Your job is to not be the person who finds out their entire portfolio was basically one crowded bet plus a narrative. So I want to hear from you. In your real life, does the economy is fine match what you're seeing with rent, wages, job security, and debt? And in markets, what do you think are the new crowded trades that everyone is sleeping on the risk of? Is it still AI? Is it private credit? Is it small caps? Is it something totally different? Drop your hot takes in the comments. I'm planning a follow-up where we break down the smartest comments, the spiciest disagreements, and of course the worst hopium we can find in the replies. If you learned something, or at least felt slightly less gaslit by the headlines, hit like, subscribe to the comment section with Thomas Paul, and turn on notifications so you don't miss the next episode. Until then, watch the signals, ignore the drama, and remember, when everyone on TV says everything is fine, that's usually when it pays to look a little closer.